Are you tired of the constant struggle to beat the market and make sense of investing? Join us as we delve into the timeless wisdom of Burton Malkiel's A Random Walk Down Wall Street, a book that challenges conventional investment strategies and reveals the path to long-term financial success. From the efficient market hypothesis to the power of index funds and the art of asset allocation, this book offers a game-changing perspective on navigating the unpredictable world of finance. Get ready to unlock the secrets of passive investing and discover how to build a resilient portfolio that stands the test of time. Burton Malkiel is an influential economist, author, and academic who revolutionized the way we think about investing. Born in 1932 in Boston, Massachusetts, Malkiel holds a strong academic foundation with degrees from prestigious institutions. After completing his undergraduate studies in economics at Harvard University, he pursued further education at the London School of Economics and the University of Cambridge. With his extensive knowledge and expertise, Malkiel joined Princeton University as a professor in the late 1960s. There, he made significant contributions to the field, most notably through his groundbreaking book, A Random Walk Down Wall Street. This influential work challenged traditional notions of stock market prediction and advocated for a passive investment strategy. Malkiel's engaging lectures and research on efficient markets have inspired generations of students and established him as a prominent voice in finance education. Join us as we walk you through the key findings of his book. A Random Walk Down Wall Street, published in 1973, the book presents a compelling argument in favor of a passive investment strategy, contrary to the prevailing belief in active management. Malkiel introduces the concept of the efficient market hypothesis, which suggests that financial markets are highly efficient and incorporate all available information into stock prices. This hypothesis implies that it is difficult, if not impossible, to consistently outperform the market by identifying undervalued or overvalued stocks. Malkiel presents the EMH by examining three forms of market efficiency: weak form, semi-strong form, and strong form. In the weak form, stock prices already reflect all historical price and volume data. This means that past price movements and trading volumes cannot be used to predict future stock prices. For example, the book highlights that technical analysis, which relies on chart patterns and historical price data, is unlikely to yield consistent profits. In the semi-strong form, stock prices incorporate all publicly available information, including company financial statements, news, and other market-related announcements. According to Malkiel, this means that it is difficult for individual investors to consistently profit from analyzing publicly available information. Any new information is quickly reflected in the stock price, leaving little opportunity for arbitrage or excess returns. The strong form suggests that stock prices incorporate all available information, including public and non-public or insider information. Malkiel argues that even insider trading, which involves trading based on non-public information, is unlikely to consistently generate abnormal returns. This is due to the quick adjustment of stock prices to new information, leaving little room for profiting from insider knowledge. Malkiel uses various examples throughout the book to support the efficient market hypothesis. He examines studies that show how professional fund managers, despite their expertise and access to information, often fail to outperform their respective benchmarks consistently over the long term. He also explores historical events, such as the efficient market response to the 1973 to 1974 oil crisis and the quick absorption of information during major company announcements. By presenting these examples, Malkiel demonstrates that markets are highly efficient and that attempting to beat the market consistently through active management or stock picking is akin to a random walk. Instead, he suggests that individual investors are better off adopting a passive investment strategy, such as investing in low-cost index funds that aim to replicate the market's performance. This hypothesis serves as a foundation for his argument in favor of passive investing, emphasizing the importance of diversification, broad market exposure, and a long-term perspective in achieving financial goals. The book covers a wide range of investment topics, from stock picking and technical analysis to mutual funds, index funds, and asset allocation. Malkiel provides comprehensive insights into the risks and rewards associated with various investment strategies, encouraging readers to adopt a long-term, diversified approach. He presents a favorable view of mutual funds, index funds, and asset allocation as part of his overall philosophy of passive investing. He argues that these investment vehicles and strategies can offer individual investors a way to participate in the market and achieve long-term success. Malkiel explains that mutual funds, which pool money from multiple investors to invest in a diversified portfolio of securities, can provide individual investors with access to professional management and instant diversification. He acknowledges that some actively managed mutual funds may have skilled managers who occasionally outperform the market, but he cautions against relying on past performance as an indicator of future success. Malkiel emphasizes that the fees associated with active management can eat into returns over time, making low-cost index funds a more attractive option for many investors. Index funds, according to Malkiel, are a key component of passive investing. These funds aim to replicate the performance of a specific market index, such as the S&P 500, by holding a diversified portfolio of stocks that mirrors the index's composition. He argues that index funds offer several advantages, including lower expenses compared to actively managed funds, tax efficiency, and broad market exposure. He provides examples of studies that demonstrate how index funds have consistently matched or even outperformed many actively managed funds over the long term, making them an attractive choice for individual investors seeking market-like returns. Asset allocation is another important concept he emphasizes in his book. He suggests that the proper allocation of investments across different asset classes, such as stocks, bonds, and cash, can help manage risk and maximize returns. Malkiel advocates for a diversified portfolio that matches an investor's risk tolerance, investment goals, and time horizon. He presents examples of historical data that show how different asset classes perform differently over time and emphasizes the importance of periodic rebalancing to maintain the desired asset allocation. He highlights that each asset class carries its own level of risk and return potential. Over time, the performance of different asset classes can vary, causing the initial asset allocation to deviate from the intended proportions. Suppose an investor initially sets a target asset allocation of 60% stocks and 40% bonds. Over time, due to market fluctuations, the stock market performs exceptionally well, while the bond market lags behind. As a result, the stock allocation in the portfolio may increase to, let's say, 70%, while the bond allocation drops to 30%. This deviation from the target allocation means that the portfolio has become riskier, as it is now more heavily concentrated in stocks. To bring the portfolio back to the desired asset allocation, Malkiel recommends periodic rebalancing. In this case, the investor would sell some of the stocks and purchase more bonds to realign the portfolio with the original 60% stocks and 40% bonds allocation. By doing so, the investor is effectively selling some of the outperforming asset, stocks, and buying more of the underperforming asset, bonds, thus selling high and buying low. This approach helps investors systematically buy low and sell high, ensuring that their portfolio remains aligned with their risk tolerance and investment objectives. Malkiel's book provides readers with insights into the benefits of investing in mutual funds, particularly low-cost index funds, and the importance of strategic asset allocation and diversification while avoiding excessive trading or frequent rebalancing based on short-term market movements. He emphasizes the significance of a disciplined, long-term approach to rebalancing, aligning it with an investor's overall investment strategy and goals. He uses research and historical data to support his arguments, demonstrating that a passive approach to investing, combined with proper asset allocation, can be a prudent and effective strategy for individual investors. By highlighting the potential pitfalls of active management and the advantages of low-cost index funds, Malkiel aims to empower readers to make informed investment decisions and achieve long-term financial success. The book's enduring popularity stems from its ability to demystify the complexities of investing and provide actionable advice for individual investors. Malkiel's engaging writing style, use of real-world examples, and rigorous research make the book accessible to readers of all backgrounds. A Random Walk Down Wall Street has become a classic in the field of finance and has influenced countless investors, financial professionals, and academics. It continues to empower individuals to take control of their financial futures by embracing a passive investment approach and maintaining a long-term perspective. So what's the key takeaway from this book? It's the realization that trying to time the market or pick individual stocks may be more akin to a random walk than a sound investment strategy. Instead, adopting a disciplined, diversified approach through low-cost index funds and periodically rebalancing your portfolio can lead to more consistent and potentially superior results. Now, it's time to put these principles into action. Take a moment to reflect on your own investment strategy. Are you embracing the power of passive investing and diversification? Are you regularly reassessing your asset allocation? Don't wait any longer. Start implementing the lessons from A Random Walk Down Wall Street today. Remember, successful investing is a journey, not a sprint. Commit to educating yourself further, seek professional advice when needed, and stay disciplined even in the face of market volatility. The path to financial freedom is within your reach. Thank you for joining us in learning the lessons from Burton Malkiel's timeless book. If you liked this video, please like and subscribe to our channel not to miss our future content. By subscribing, you become part of our mission to bring financial literacy to all, regardless of background or privileges. Your support fuels our commitment to creating high-quality content that empowers individuals to take control of their financial futures and achieve their goals.